Let's talk some earnings as well and some news flow from yesterday. Jenny Horne here with me in studio, host of Next Gen Investing. Earnings from Lyft. Jenny, I think the things we're going to talk about here, Lyft and SMCI from yesterday, obviously not as big of kind of a macro impact. These are sort of stock-specific stories, but given the investment from Bill Ackman into Uber and all the excitement about self-driving and Lyft talking about getting their program going in Dallas, earnings creating some pretty notable volatility for the stock.
Hey, and motor vehicle insurance, which is a stretch to tie, but it was up 11.8%.
Yeah, no, it is, because you got to get insurance when you're driving Lyft.
That was a notable increase in CPI today, so that is maybe our tie-in. But mixed print led to a pretty stark sell-off here in shares. I mean, revenue was around $1.5 billion. That slightly missed the mark. Active riders and rides data were also in line with expectations. So I will say that it wasn't a bad report by any means. We did see...
Right, it spiked originally.
Right, so I think that speaks to the fact that there was good things in this report. We saw they announced their first ever share repurchase program valued at around $500 million. Also reported their first full year profit with 2024 net income at around $23 million, comparing to a loss of $340 million back in 2023. So substantial improvement there. We also saw that now, as far as expectations, they're seeing gross bookings ranging between around 4 to 4.2 billion, slightly shy of the 4.23 billion expected. And they do forecast their ride-hailing growth to be in the mid-teens and gross bookings to grow between about 10 and 14% from the first quarter. So we've seen shares rise about 16% in the last 12 months, still though down 70% over the last 5 years, which speaks to more of the pain of Lyft.
Yeah, I mean, I didn't think it was going to get hit quite this hard. The numbers didn't seem terrible in terms of their miss. I know they missed, but still a lot of positives there on the numbers from active riders to bookings too. So a tough crowd when you've got a lot of competition, and it's going to get even more intense with the developments from Waymo, Uber, Tesla, et cetera, for all the self-driving cars. So it's going to get tougher. How about Supermicro? This one, I did think when the information came out that it was a bit disappointing. Thought this was going to be an easier bar for them to get through, but they're really taking this down to the wire to not get delisted. I mean, they said they expect to have their next key filing on the 25th, which is the last day, right?
Yeah, that's essentially the deadline. So interesting move. I mean, they missed expectations. We saw preliminary results that were not exactly promising, slashing their sales outlook now for fiscal 2025. However, their revenue target for fiscal 2026 is higher than estimates. So this tells you, I guess, you have to stick around and wait for 2025. And shares are amazingly so rising on the news. Although I will say the intraday chart is actually pretty interesting because we surged, and now we're giving a lot of that back since we got CPI. So a bit of a mixed, I'd say, reaction. We could actually, I'll be curious to see where we open. But right now, the preliminary results do translate into year-over-year growth of about 5% in earnings, 54% in revenue. Also lowering their revenue guide again for 2025 to 23.5 to 25 billion. Prior outlook had upwards of 26 to 30 billion estimated. And they said that right now they're modeling more and more like growth in the coming years. They did say they have until February 25th to regain that compliance. So they're really cutting it down to the wire. Just amazing to me, we even initially popped as substantially as we did on what was objectively a miss.
Yeah, and then it gave back and it started to slip and then it firmed back up. So I guess market is looking through some of the issues accounting-wise, legally. Government's looking at them now. But the message about the market that they're in is still pretty compelling. I think there are a lot of investors desperate to find unloved AI plays. And it's still an AI play. And of course, it's definitely unloved since this whole thing happened. So I guess maybe that's why it's still catching a bid. Folks really want to find a so-called value trade, perhaps, within this category.
Right, and we do know like a week ago they did confirm they're in full production now of Nvidia's Blackwell rack scale AI computing system. That helps. I mean, like the fact that you can tie on to one of the most successful companies in the AI trade is huge. But I think that similar to what we've seen in some of these like third and fourth tier AI companies where you have to really consider is still repricing in this entire industry. What they do right now, I think, is threatened by the DeepSeek model. If we see less liquid cooling needed and we see less data centers, I mean, like with costs that are not as elevated as we thought, this name takes a hit from that.
Yeah, I think it's a very fair point. There's still questions to be answered on whether or not the more efficient, cheaper alternative is going to be used, and you won't need as much sort of accessorizing of the machines
That's right.
and the data centers. All right, good stuff. Thanks, Jenny. Appreciate it.